Now it's time for On Point, where we speak to experts to delve deeper into the biggest news stories in the spotlight right now. South Korea's central bank last week hiked its base interest rate to pre-pandemic levels as policymakers tried to get a handle on soaring inflation as well as skyrocketing household debt. Now, the decision by the Bank of Korea to up the rate from 1% to 1.25% was widely expected by analysts and was the BOK's third increase in just half a year. Now, South Korea, it must be stressed, isn't the only country attempting a similar tactic, as central banks around the world, including in the US, the Federal Reserve, are trying to balance rates in a bid to tame inflation.
And inflation is of particular concern for South Korea. Recently released data showed consumer prices in South Korea in 2021 rose by 2.5%, a high not seen here in 10 years. For more on the economic currents affecting South Korea as we seem to be coming out of the other side of the pandemic, we connect to Professor Oh Jun-seok of Sookmyung Women's University of Korea. Good morning, Professor.
Morning.
So, Professor, how do the upward changes in the base rate effect affect regular people? So, for instance, how can it be felt in things like mortgage payments, the credit card bills, and their savings?
Interest changes have multiple effects in an economy. Simply speaking, as interest rate refers to the price you pay for your consumption or debt. So, interest rate hike implies price increase of your consumption. Bank of Korea expects consumer price to rise at around 3% for a considerable time. In a way to curb down this kind of inflation pressure, BOK consistently give a market signal to interest rate hike. As a result, people tend to be more selective in their consumption and to save and invest more for a rainy day. Commercial banks are raising interest rate on deposit following the central bank's rate hike. Inflation pressure could eventually be controlled as consumption deflates. Interest rate hike means extra burden you pay for your debts. When you got mortgage, no wonder your payment will be increased as mortgage and credit card have strings with variable interest rate. BOK said at the annual interest rate payment by household as a result of this kind of reference rate hike will amount to $2.7 billion US.
Now, some economists argue that playing around with interest rates isn't necessarily the best way or the only way to try and tame inflation. Some of them say while it's a medicine of sorts, it isn't always necessarily the correct medicine in these situations. What side of the argument do you come down on?
Yes, it is true there is no universal right or wrong in a way to control inflation. But it is certain inflation should be kept under control in any circumstances. Once inflation triggers to boil up, depending upon the prior situation and posterior effects of economy, right or wrong approach might be determined. Changing money supply in the market could be an alternative, if not the contingent situation considered. Now go back to the current situation. There are two tools in monetary policy. One is interest rate changes, and the other one is money supply changes. The reason that the central bank now select interest rate hike is because money supply has been used up as policy tools for boosting up the economy for the sake of universal basic income, disaster relief fund, or supportive financing loan whatsoever. Economists had in unison suggested supportive fund targeted for the selected income group only, counting the possibility for another monetary tools in the future. If expanded money supply failed to return to normal, inflation pressure cannot be controlled within so short a time, it could break out a stuck in the middle situation. Stability of the market price cannot be trusted among people, market transaction dwindles. Therefore, what's left now is interest rate changes. Moreover, affordable time to step up interest rate hike is not that much left. Extra burden will be heavier as time goes.
Now, Professor, the Bank of Korea often cites soaring household prices as one of the main drivers of rate hikes. So can you explain why higher rate hikes stop people borrowing against their homes or taking out new mortgages?
Interest rate hike stands for extra burden you have to pay for your debt. Abundant liquidity is the major cause of inflation rate and rate hike. On the other side, abundant liquidity also be the source of market consumption and yes, source of purchasing houses by way of a bank loan with lower interest rate than the higher growth of price increase. So what will you do when a rate of return is greater than the rate of borrowing cost? Bank loan was the major funding source, especially in Korea. In the property market, interest rate hike might be less and less affordable to borrow money from the bank, increasing cost of capital. In addition, the government made a restriction of the banking loan for purchasing real estate. Korea's outstanding household debt in the third quarter of last year was amount to 1,845 trillion won, and the debt is projected to break 1,900 trillion won in the first half of this year. By cutting liquidity and interest rate hike simultaneously, I think it is a right policy measure, and the government could make debt finance speculators twist and sell their houses in the market, decrease the overall price of real estate.
Okay, well, finally, in 2020, you could argue that most economists had the same view of what 2020 might look like with the outbreak of COVID-19. Pretty much the same for last year as well. But there seems to be two clear camps forming in regards for forecasts for this coming year, 2022. One side presenting a very rosy outlook, the other side saying, you know, we're not quite out of the woods yet, don't get too optimistic. Which camp would you say you're in and why?
A few months ago, I thought I could see the silver lining of resilience of global economy. Korea will be expected 3.4% of economic growth. However, the advent of Omicron variant has changed a lot of our outlook into doomsday. Uncertainty remains in an economy due to supply chain bottleneck, battling already changed 3.1% target growth of economy, and then discouraging bouncing back trend of investment, production, and employment. The effect of COVID-19 pandemic could have calculated already and discounted as risk factors, but they cannot count the Omicron variant in the projection. In spite of this Omicron variant, I thought that 2022 will be a better year than 2021 with the help of a consumption recovery and restoring distribution channel, and thus increasing inventories in the global market. In this respect, first half of 2022 will show a apparently brighter prospect for economic growth getting out of bottom, driven by semiconductor, automobile, and steel industries. What matters more is the latter half of 2022. It seems rather sluggish in economic cycle, in addition to financial uncertainties in the global market, unless otherwise inflation and the variant prolongs.
All right, Professor Oh, as always, thank you so much for your insights. Have a great day.
Thank you.
Thank you.